So this was requested by Jim. It's a pulled pork first. There's two pulled porks. First of all, on Core Lithium, and then on E-Roads. Um, and I have to say, they may have been on the buy list recently, but they're both just off the buy list at the moment. So bear that in mind if people are listening to this. They should do their own research. Starting with Core Lithium, which is a Northern Territory lithium explorer and now miner. They've started to export mine into China. Their biggest, well, their big project, which is just getting into operational status now, is the Kynaston Lithium project, which is just south of Darwin, about 88 kilometres south of Darwin. So that's a bonus for them because they're not running an hour outside of the port of Darwin, which is where they need to export their stuff. So that'll be a cost saving for them rather than being in the middle of the Western Australian desert or something and having to build a rail link to the port. So that's good. They have already signed offtake agreements with two large Chinese lithium companies, Sichuan Yahua and Ganfeng Lithium, both of which I've never heard of. But it's always good for a miner to have an offtake agreement, so it's guaranteed sales. They're also growing because they are progressing a second tenement area known as BP33, which may end up being bigger than Finnis. And that's not too far away from having a go, no-go decision on developing a mine. So they should grow if that goes through, or they will grow if that goes through. And they're going to grow anyway because they're going to, this year, the latest figures don't have much in the way of sales. So as they ramp up the mining at their current tenement, their sales will increase as well. A couple of things about Core Lithium. They're a small company. They've adopted an interesting style of mining. So they talk about having a lot of little mines in close proximity to each other rather than one big mine. That may or may not work out, but it's a little bit different to how we normally expect a mine to look. They famously turned down an offtake agreement early on with Tesla. So Elon Musk came knocking before these Chinese offtake agreements were secured. And they talked for a long time. The market went crazy on the fact that Tesla were interested in a small Australian company which didn't even have a mine operational, I don't think, at that stage, or was in the stages of doing that. But they couldn't come to an agreement. And I think Tesla's had a bit of history of going into startup mines to do deals at low prices. And so it didn't come to an agreement. When that didn't happen, the share price went down because there is a bit of a premium if you can get a big customer like Tesla on the books. All of the ESG investors tend to look at you even more so, although they look at all lithium companies. A couple of other things about this one. It's the most one of the most heavily shorted stocks on the ASX, and it currently has 12% of its shares shorted. The price for this company has dropped dramatically since August 2022, which was its high point. It's down from $1.40 to 31 cents. Having said that, it still remains above its buy line, so that's in its favour, even though it's a falling knife. This is probably a chicken or egg situation. I'm not sure whether the share price is down because it's being heavily shorted or because it's down because the shorters are paying attention to the lithium price, which is also down dramatically in a similar sort of period. Its high was $600,000 a tonne in November 22, and the lithium price is now down to below $100,000 today, around 97.5. So it's down dramatically as well. I suspect the mining companies are following the commodity prices they usually do, so that's why the price is down. But one of the positives for this company is that if the lithium price does look like improving and turning around, and the short sellers will probably all have to do what's called a short cover, sell their stock and give it back. Otherwise, they don't lock in their profits in case the core price takes off. But just that process of getting out, because what they actually have to do is buy the core stock to return it to the people they borrowed it from. Because if you're shorting, you borrow the stock, sell it, and then buy it back at the bottom and give it back to the person you rented it from in the first place. And that generally creates a bit of a price spike, just that process alone. And if 15% of the stock has to do that, we may see it turn around.
I think it's known as a mini skirt, Tony.
I'm sorry?
It's known as a mini skirt, short cover.
Okay. You can edit this out, but we once worked with a lady who was known as Terrigal because she wore short miniskirts, and we always thought she was a bit close to the entrance. Well, they were a bit close to the entrance, which is a location joke in New South Wales.
Right. Over my head. Okay.
Two places, one called Terrigal, one called the entrance. They're both beaches north of Sydney.
Right. Right.
Anyway.
Very location specific, yeah.
Yeah. So the numbers for this pulled pork, this is a large ADT company of nearly $6 million. So that's a positive. The share price, when I did the analysis, was 30.5 cents per share, less than consensus target, and almost IV2. So IV1 is 3 cents. IV2 is 29 cents. So not quite below IV2, but fairly similar. Doesn't have a yield because, as you'd expect with these sort of startup mining companies, all of their cash flow goes back into setting up the operations and expanding. Stock Doctor give this company financial health of strong and a trend of recovering, which we like to see. So it gets a good score for that. If we were scoring on PE alone, we get a bad score because the PE is 51 times, and therefore it fails our test for the last 3 years. But that should turn around because it's expected to grow. The earnings are expected to grow next year. Having said that, though, price to operating cash flow is just over 7 times, 7.23. So it's just off the bottom of our buy list. But again, that could turn around with a fluctuation in the share price if that happens. Net earnings per share is 16 cents. So it doesn't score for us on that basis. Book plus 30 is 21 cents. Share price is just over 30. So we can't score it based on its assets. Earnings per share forecast growth, however, is 400%, and that's due to the mine ramping up. So growth over PE is nearly 8 times, which is way above our threshold of 1.5, so it scores well for that. Interestingly enough, no owner founder, directors hold 1% that I could see anyway, so I can't score it for that. Sometimes you do see that in these small mining companies, but not the case here. Equity is consistently increasing, so it gets a tick for that. So all in all, the quality score is 9 out of 14 or 64%, and the QAV score is 0.09, which is just below our cutoff of 0.1. Having said that, I mean, the 0.1 is arbitrary, so if someone did like this company and wanted to buy it, they could look at it at 0.09, I would have thought. But it is a falling knife at the moment, so I wait until sentiment turned. I suspect when sentiment turns, it's going to turn strongly because the short sellers will be buying stock to give back to their lenders, and it'll kick off quite nicely. So that's a positive for it when it does eventually turn. Negatives and risks, I guess. The lithium price is probably the biggest risk. It's still depressed and trending down, and I've seen this before with mines and commodities. It's a commodity that a couple of years ago was in high demand, largely because of its role in electric vehicles and other electrification uses. So it meant the players who were already in the field did really well, but it also invited lots of new mines or lots of mining companies to explore for lithium. And so there is more lithium in the market now. So that'll settle down to an equilibrium that works out in the long term and is economical for most parties, but at the moment it's now in oversupply. Other risks, probably the other biggest risk I can think of is that there has been noises made in Australia, but also in the US about exporting certain minerals to China, and the two offtake agreements this company is relying on are both in China. Now, the government hasn't come out and said that they have a policy against sending lithium to China. I think they have called out some certain minerals to regulate exports overseas, but I don't think lithium's on that list yet. But it may happen if they decide to expand their regulations of precious minerals or minerals that aren't freely available to China. So yeah, I think it's a watch. I'll be watching the lithium price before I bought into this one, but longer term it probably should do okay. So that's Core. And I mean, again, before I leave Core Lithium, it was only a couple of, maybe even a year ago that at least one couple of friends approached me and said, I've been told I should get into lithium. It's the next biggest thing, and it was a boom, and it was the price was up dramatically, and companies were mining lithium, and their share price had gone up 4 or 5 times. And of course, that was right about the time that lithium peaked and started to drop, and it's dropped to 5/6 of its price. So it's dropped a long way down from that high. It's the old classic proverb: when the tip hits the retail market, you hear it from people who don't usually buy stocks, it's the time to get out. So that held true in this boom,
I
the
think
lithium boom, and it holds true in most booms.
I think my sister was one of those people.
Oh,
One of my sisters said to me, "Hey, what do you think about investing in lithium? I've heard lithium's the place to be." Probably from somebody at a church. I said, "Yeah, be careful with that."
yeah. So it'll probably have its day again, but at the moment it's depressed.